All right. Hello, everyone. This is the PetroNerds podcast. This is episode 34 of the PetroNerds podcast, and I have a fantastic guest for you here today, which I will introduce. This is Dan Pickering. But before we get started, it is Friday, November 19th, 2021, and I really do like to put timestamps with these podcasts with oil prices because holy crap, they've had a nice backsliding in the last few days, and really today. So WTI is 76.10, Brent is 78.72, and nat gas is 508. I did see that hit a four handle last night. So prices are all over the place, and we are. I can't help but talk about oil prices and OPEC and the trajectory and why things are moving. So definitely want to talk about that. But we're going to cover a number of things because Dan Pickering is a wealth of knowledge and a leader in this space. He is the chief investment officer of Pickering Energy Partners, and a lot of folks are familiar with that. But I'm happy to let him discuss a little bit more about what Pickering, 30-second intro on what Pickering Energy Partners is. And but this is a podcast full of intel, and Dan has made. I came across him on Clubhouse and some stuff with Chuck Gates and the Clubhouse with Chuck Gates over the summer, and so we've interacted on a number of forums, but haven't really got to just sit down and nerd out. So that's what this podcast is about. So with that, Dan, thank you so much for coming on the podcast.
Glad to be here, Trisha. Thanks. I'm ready to nerd out.
Awesome. That is the answer I liked here. So would you like 30 seconds to tell folks about Pickering Energy Partners?
Sure. So Pickering Energy Partners, we are a kind of an investor and an advisor around the energy space. So we've got an investments business, public and private, putting money in companies in the energy space, both traditional energy and energy transition. We've got a consulting business that has done a lot in the ESG area with energy companies as well as regular way energy. We've got an insights business. David Heikkinen runs that business where we're working on market intelligence around companies and energy macro. And then we've got an advisory business where we're helping raise money for companies. So everything has a traditional energy bent that's also expanding into the energy transition. And I have to finish by saying I'm on podcast number 34 of PetroNerds, and my high school basketball jersey number was 34. So this is going to be a great hour.
It really is going to be a great hour, and that's awesome. I appreciate that, and that's a great intro. It's also cool because the more guests we've had, a lot of us are cross-pollinating in these same spaces. Obviously, I don't have a private equity fund or investment fund, but we're doing a lot of the same stuff, and I think it's great because the market is it's a bit crazy right now. And I do a lot of advising stuff for clients and working with clients, and doing a lot of quarterly reviews, and those are tending to be like monthly reviews and now becoming weekly phone calls because these market changes are kind of crazy.
Happening fast.
It's happening fast. And so there's a number of things going on. The last podcast I did with David Ramsey-Wood and with, the previous ones with Mark Rossano, I talked a lot about inflation because I'm a bit obsessed with it and obsessed with inflation and high oil prices. And we can start there of the fact that, prices don't seem that high today. And given that they last night they were backsliding $5. So, I mean, a couple things I would love your take on this, but really market sentiment has a lot to do with it. And I was in a bit of a Twitter banter with Energy Credit One a couple days ago on the role of the administration and sentiment really, I think, in energy prices and what they can do. And I think it's interesting that everyone said, folks on Twitter were saying, well, the administration can't do much to actually cool energy prices in terms of production and everything. But market signaling has a lot to do with I say $5 on upside and downside. Traders move oil prices $5 either way pretty fast. And it seems to me that one, there's a couple things going on is that COVID scares are ramping up. So Austria, Germany is closing down places, they're shutting down Christmas markets, which is a big deal in Germany. And then Australia is looking at that's been going on a long time, but Australia just like it was coming out of it. And now they're going lockdown again. And now they're doing vaccine mandates. These are pretty big deals for, potential oil demand. And then, and I think that's more jitters and fears of, as opposed to what are the actual volumes. And then we have, Biden basically moving the needle a little bit with Xi Jinping and saying, hey, we're looking to get China to release some of their strategic petroleum reserves. Now, whether or not they actually do that is unclear. The volumes are unclear, but oil prices slipped $2 immediately, went from 80 to 78 immediately when we heard that China may release some strategic petroleum reserves. And it sounds like India may. There's no clarity on that as well, but it sounds like India may release it as well. And so if you put that together with the U.S. might release some strategic petroleum reserves, China might, and India might, that's enough to actually for traders, I think, to pull down prices. And then you have all these COVID fears. So pack that together, and it's a Friday, and people just want to sell off a little bit. That's my take in a nutshell.
You said a lot of the same things that I had written down here when you mentioned the word inflation. I mean, let's take one step back, which is I think we are in an inflationary environment in general. There's the big debate about transitory versus persistent. Certainly as supply chains start to moderate or improve, I think we'll see availability of goods and services improve. But wages are a big component of costs, and they're going up. And when they go up, they don't go back down. You don't bump somebody's pay and then take it away next year. And I
Exactly,
think we're
which is
seeing that.
why, yeah, which is
Yeah,
why the word transitory is a little bit BS.
it's tough. Yeah, it's tough. So I think there's an inflationary environment, as there ought to be, given all the money that everyone in the world has printed. So the bias is for they're trying to support economies, but you create inflation, and the question is, do you overinflate? And I still think the risk is more on that front than the transitory front. And then play that into commodities, and you've got an environment where COVID kind of screwed everything up, if you will, from a demand perspective. But as that demand comes back and normalizes, we've had a supply response in the U.S. that isn't going to change quickly. So I think you're right. Near-term commodity prices today, my view was it was more COVID than SPR releases. From 83 to 78 or 9, I think it was SPR, and today it was COVID. And I get it. That makes sense. It's the front month represents near-term supply demand, and that's a scary issue. So, and then you've got some profits today. I mean, we've had a big run up here in crude, and so can you take $3 or $4? I mean, it's still a good price. So, I don't think we've necessarily changed the fundamental dynamic, other than, if anything, if we get this coordinated reserve release, I mean, OPEC's going to be even more probably disciplined or adamant about coming
Absolutely.
back slowly, because you've got this other kind of geopolitical element that's come into play. So I'm I think the one other thing that has entered the equation in the last probably month has been this concept that the market gets sloppy next year on a supply demand basis, and so maybe oil prices were ahead of themselves looking into this imbalance. I kind of think the market's going to be perceived as tighter than it is, even if we see a little sloppiness next year. So I've been in the camp that said we're probably biased to go to 100 faster than we are, more likely to go to 100 than 60. And I'm still in that camp.
Yeah, so I think you're right there. I don't disagree that that's where the market's going, and that's where traders and sentiment are taking it. I don't think the market's as tight, or it wouldn't move this way. Like, it's interesting that it moves so quickly one side or the other. But if the market was as tight as people say it was, and it was going to end these $200 calls or Bank of America 125, it would already be closer to 100. I
Yeah.
just really think, so it's not, the fundamentals just aren't there. And the problem is we have to do look backs on actual supply and demand. We have to really see global supply and demand. We know the US, and the US, like last week, this week, our data for demand was great. I mean, we had, a few weeks ago, right in October, when we had a little bit of a couple dollar pullback, and you actually had some service companies have their earnings calls that day, and they lost a couple bucks on those calls because oil prices dropped. And that was really, we had a stock build in crude inventories, 2 week, double week over week, we had a stock build in crude inventories, and we had slightly soft demand in the other oils category, which includes jet fuel. But this week was great. Gasoline was up, diesel was up, everything was up, jet fuel, other oils, everything was looking good. So demand in the US, you do have line of sight on that. I think that, and I agree that OPEC is going to be more disciplined. I mean, we're you can't you can't ask these guys to add barrels to the market and create volatility. And I'm not in a huge defense of every single player in OPEC, but this is how business is done, and you can't just add barrels in and then just hope. Volatility is a problem, and so if they were to add a bunch of barrels back without really having clarity on the market, and I mean they've been saying for a while that the second half of the year of 2022 might look a little softer, and IEA has also said that, so that helped with prices this week. Is that IEA has said, hey, things are tight now, but they're going to get softer in the second half of next year. I really do think that next year looks different because I think that inflation bites, and I think economic growth, when I'm looking around the world for a nice picture to tell me why things are going to look great, there isn't a whole lot. Pent up demand only lasts so long, and I mean it's great that people want to get out. I don't think the COVID shutdown thing is going to play well in the U.S. if they try to play the Austria and Australia cards here. I think people will absolutely push back because they've fed up to the eyeballs with it. So I think that's going to be a different story across the globe. So we'll see how that plays out with oil demand and how the market responds to it. But in terms of economic growth, I'm just concerned that retail sales look good in the U.S. Recent retail sales, but I'm one of those people that, hey, I'm get the stuff for Christmas now. You're worried you're not going to get it in time for Christmas, so buy it now. And by the way, we didn't see everybody for Christmas last year. We're making up for it this year. Doesn't mean the health of the consumer is doing that great. I think Mark Rossano has commented on these payday loans and different things. I personally don't think people are in that great a position. I think they've banked on the fiscal side a little too much, and I think the cushion for a lot of consumers might not quite be there. And so I think the second, next year could look a little bit different than it looks now, and so there might be a false sense of security with the retail sales in the U.S. consumer, and we are certainly seeing weaker than expected. I mean, they had revised their retail sales down in China, so they didn't look that bad. But holy crap, Alibaba got smashed last night, and that one Alibaba saw weaker than expected sales, so that wasn't good. They've also been really heavily hit by the regulatory crackdowns within China. So there's a number of things going on there, but that showed some serious weakness that I think people need to realize. So those and those inflationary pressures, the fact that we're just sort of disregarding them in these retail sales, and folks think the U.S. consumer is okay, that might be a little bit of a false sense of security. So I am concerned about that in terms of how next year looks. And I do think all of this 6.2% in inflation, even if that was to start coming off, those wages don't decline immediately, and it means folks like me, that's a small business, struggle. If I want to grow and add people, it's going to be hard for me to add people because I can't find them, and I can't pay them enough to get them here. So I think that's all. Those are headwinds, not tailwinds for the U.S. economy.
Yeah, whether it's 20, it's a big difference if it's 22 or 23 or 24, right? I mean, I continue to grapple with just this concept of where all the money goes, and at some point, the combination of having to pay back this money, a la higher taxes, and a weaker dollar and things like that. Right now, the dollar's strengthening, so you've got a number of different dynamics at play.
Can we just hone in on that for a second? Because I'd love to know your thoughts on that. Because a number I just recently heard, and it was the combined figure. It was the 26 trillion has been injected into the global economy since March of 2020, including monetary and fiscal side. So our M1 money supply is ridiculous. I mean, we put trillions and trillions of dollars into the system, and we do seem to be, spending like drunken sailors in the White House and on the Hill of passing everything. If it's got a trillion note, even blinks an eye. And I think it's getting a little bit scary because it does have to be paid back. And so there's a fiscal side that's important to this, that combined with the monetary side, if there's just a lot of money sloshing around in the system, and this dollar and the role of the Fed, doing or not doing anything. And folks, it seems like when I stay up late and I'm listening to the market, whether it's CNBC World or it's Bloomberg, and you listen to all these pundits that pop in, the concerns of inflation they strengthen every day and every night. I've been banging on my podcast since the beginning of this year that it's very, very real, and month over month inflation is here, which the Fed said it wasn't, but that's what we'd need to be concerned about. Now we really have month over month inflation. We have 6.2% inflation, but the stronger dollar is sort of like, well, maybe if the Fed chair, if Biden keeps Jerome Powell in place as the Fed chair, and he's less He's more hawkish, which I don't think he's a hawk at all, but he's more hawkish than the other alternative. I mean, there's a lot of stuff, and the dollar's looking good because what people think that the Fed will be forced to, because inflation's so bad that the Fed will be forced. And it's interesting because when you listen to all these analysts stuff on TV, basically they say, no, it's fine. The market's going to be fine. It's going to keep going up and up. And, the Fed is going to continue to be dovish. And I just thought, history doesn't tell us that. History tells us that when your hand's forced, you have to react. And what if inflation goes to 10%? And what if inflation goes to 10% and some of these fiscal things roll back and we find out that the consumer isn't that healthy? I think things are being a little bit jaded here. And so I'm just curious, what do you think's driving that strength in the dollar, and what's your interpretation of these Fed things, just from a risk standpoint, not necessarily from a political standpoint?
Yeah, I think we got a stronger dollar because our rate picture, one, our economy looks, I think, pretty decent, and two, you've got uh, a view that U.S. rates are moving higher. So I think that's feeding part of the dollar strength. I mean, it's all related, obviously. Let me give you two stories. So in terms of how I think about this, one is, you're right. When this ends, it probably doesn't end with a 4% pullback in U.S. equity markets. It's going to be much more challenging than that when it ends. And we're going to look back and we're going to look at Dogecoin and NFTs and Michael Jordan shoes selling for $1.4 million. And I just saw a blurb that Ken Griffin bought the U.S. Constitution for $42 million or whatever. All of these things are signs of people stretching for places to put money to work. And we're going to look back at the valuation of Tesla and a bunch of other companies and say, it was so obvious that this couldn't last. Now, so that's story number one, is that will be it was obvious.
Many of us are saying this now and have been saying this all year. So
yeah.
Yes.
Okay. And so that leads to my second story, which is when I started at Fidelity as a young analyst out of business school, we were looking at the time. The great thing about Fidelity is there's so much information and everybody's deep in everything. And a guy came in, and one of my fellow early analysts came in and said, look at this. And it was consumer debt. Like, look at how much debt the consumer has. This can't last. It's going to kill us. So that was 1994. And in 2008, we had a crisis around too much consumer debt and the housing crisis and all that. So my point is, some of these things that seem obvious can take lots longer to play out than we expect. And so I don't know if we've actually had the whoosh that tends to be the end, right? If you think back to 2001 and the tech bubble, have we had that tech bubble moment where Sky Mall triples in a day because they say they're going to add an internet presence? I don't know that we've had that yet. And I don't know that it happens with oil at 70, but it might happen with oil at 110. I don't know if it happens with interest rates going from 150 basis points to 190 basis points, or if it's got to be 350 basis points. I don't know. And so that's why I think this timing is really tough, because everything that you said about inflation could kill us, and it might be 3 more years. And if it's 3 more years, they will be 3 more great years, because that's how these expansions end. Is, everybody's got to pile in, and there's so much money looking for a home still. And meme stocks, right? All these people have money, and they're plowing it into weird stuff, including equities. And so I think there's more gas in the tank is where I'm at.
I think that there could be more gas in the tank. I think the next few months are really critical, and winter. But I still want to think, when you think this bullishness, and timing is everything, right? I mean, I've been a perma bear on China for a long time. There's a different thing there, though, because they can mask the data, and they certainly are. And that's a big problem that people are having now, is that, the data is always there. So we, like you said, 1994 to 2008, the data was there. People just didn't want to look at it. And the data is here right now. These valuations are too high. Personally, I mean, I've been wanting to, I have a small amount of savings. Do I want to invest in it? I don't. Not right now. The market looks way too damn frothy, and people, what Edward Jones and stuff tell me is like, well, keep putting them, putting the money in, and it's good. And I thought, actually, I know I've I'm overly cautious, but it's like, now why not wait a couple months? If you've already waited a little bit, just watch the winter, because the winter is, look, if the weather's really cold in Europe, or the weather's really cold in Asia, or just one of them, or slightly colder than it needs to be, and there's a worse energy crisis than we have now, I think that the straw, it could be the straw that breaks the camel's back. And the fact that in Europe, the fact that globally people are criticizing, the our Fed, for not raising, or they're raising rates, right? People are assuming that the Australian bank is going to have to turn tail and actually raise rates, even though they said they wouldn't. New Zealand's going to raise rates. It's expected that the Bank of England's going to raise rates. So why is it okay that all these other countries can raise rates, regardless of what caused the inflation, but they're going to address it? But it's not okay that the U.S. for the U.S. it's not okay. We have to address maximum employment, which is fundamentally changed, and we're already dropping employment like live, but yet we're refusing to do QE faster, and so we're not pulling off the quantitative easing faster, and people are likening this to previous times with QE and saying the 4% correction. Well, holy crap, the quantitative easing we had before was like a drop in the bucket compared to what this is. So we're talking about these 120 billion. We're still putting extra money into the economy each month, whilst we have this 26 trillion. So when people want to know, well, why is everyone not back to work? There's still a fiscal stimulus lag. I mean, do you still have money out there? And you still have all this money. So things look too good, right? The market's still going up and things look good. And it's the black swan is never that thing that we all know. It's like, what's that little thing? And people keep saying, well, it's not the Evergrande. Evergrande is not Lehman Brothers. And it's like, okay, maybe Evergrande isn't the Lehman Brothers, but their property sector is going to hell in a handbasket, and they're just covering it up every day, putting some straw over all that horse crap, because it doesn't look very good. And I'm trying not to cuss, because I found I have to give a shout out. I was at the ACE scholarship luncheon last week, and Jay Leno talked, and the room's packed. People are donating lots of money. It's great. And a guy comes up to me and says, I got to introduce you to my wife. And I was like, well, I need to know who you are as well. I mean, and he says, oh, I'm a Tappan Souther. I work for Liberty. I work for Liberty Resources, and this is my wife, and she listens to your podcast, and we all listen to your podcast, and our children listen to your podcast. So I realize I have to stop cussing if children are listening to this. But anyways, I diverged. That being said, we have this perception of the Fed, and you mentioned this. So do you think that people are baking in, we're going to have these rate hikes, but right now, every time the Fed comes out and says, it's like, nope, we're going to do the QE till June of next year, and then they'll start doing 2 rate hikes. And the market seems to be comfortable with these 2 rate hikes. Some people are baking but others are saying, nope, it's not going to happen until 2023. And I guess where inflation is and where the market's interpreting it is, we're definitely going to have some rate hikes next year. So is that the real, and is that how you guys are thinking about it? But those are small rate hikes, so that's not going to go crazy with the economy.
I think so. We're a little bit outside of my area of expertise. Obviously, I'm an energy guy, not a interest rates guy. I think that the Fed and the world are playing this fine line between allowing things to overheat, protecting things from blowing up, and in the meantime, you've got what they're signaling, and then you've got what the markets are actually doing, right? And so I think it's going to be hard to raise rates too much, because you got a lot of debt to pay, and all of a sudden that really gets problematic. And you got a population that's got a lot of debt to pay as well, and so that gets problematic for them, housing and other variable rate stuff. So I think rates are going up. They probably have to go up enough to kill the economy. I mean, right, if you think about cycles, we save things, so that troughed it, which means the next move, we're between here and a top. I don't know where that top is exactly, but you probably raise rates until it happens. And the question is, will 1 or 2 do it, or does it take more? And then everybody's trying to game this timing, which I don't have a clue about. I think the one comfort for me as an energy guy is that
don't worry, I'm bringing this back to energy. There's a reason I've got you going on all this.
Yeah, well, I was going to say energy. if we have an inflationary environment, energy is probably a winner, both absolute and relative. And And if rates don't go up much and the economy is good and demand grows, we probably win as well. And so it's hard for me in the near term not to see another leg higher for either the commodity or for energy stocks or both. And then you got to worry a lot because we now, COVID showed us when demand rolls over, it's really sucky and you want to own nothing and you want to be gone from this sector. And so I think what we have in the energy sector is we're playing this, we're playing the there's got to be another up move probably, and then you don't want to overstay your welcome. So you're kind of worried about the next downturn, and it's not like stocks are on their trough values anymore. I mean, they've gone up a lot. I think they can go up a lot more, but you're going to have to pay more attention. I think when oil was 45 and stock prices were half of where they are today, you just had to believe at some point in time the world would get better. I mean, I wrote a lot about you're getting paid to wait. You can just, if you own stuff that's not going broke, you're going to make money. Well, we've made some of that money. Now you've got to be more focused, I think.
Yeah. So, but that's particularly to the oil equity space, which is a great, very nicely done with your transition here and bringing this back to me. And there's a point in this, and I think that's because you've, as I mentioned before we clicked record, a couple of introductions I had to you was when I saw you on CNBC talking to Kelly Evans about some of the green stuff, and I do want to talk about that. And I have been honest and very vocal, and I was a little, I wouldn't say I'm very open-minded. I'm happy to change my opinion and alter it. And that's the only way you can be with data coming in and helping clients. But I'm not nearly as bullish on or as open-minded on the bullish side of green tech as toward the beginning of this year, because I do think the interest rates and the environment are changing the dynamics. Now, if to what you just played out, if it's a very slow roll on those interest rates, that helps tech, that helps green tech, that helps everything. But I think we've got sort of a very mixed, nuanced picture in the world of sort of this green tech and ESG and everything, and oil and gas. And when you're talking about U.S. oil, when you're talking about oil equities, that's a tough spot for them to be in because they're also trying to invest, right? And they have lots of pressures being, I talk about this ESG monkey on their back, and I think it's, the size of that monkey, depending on the company, it's a mess because they don't even know what to do necessarily. It's that monkey whacking them over the head. And it's not like, hey, just invest in this or just do this and everything will be fine. And so I think you have those pressures, and then it's also like you're an oil company and your job is you're making money by producing oil and gas, and oil prices are high. So that's what you're supposed to be doing. And then on the back of that, you have, you actually have the president of the United States saying that, going to the FTC this week and saying there's a difference in prices. Even if oil prices have went up or down, there's a difference at the pump. And he didn't call out refineries, and he didn't call it retailers, and he didn't call it convenience stores. He actually called out oil companies for making a lot of profit and hurting the U.S. consumer. So I think there's a lot of factors going in from a pressure standpoint. But these oil companies, if you're saying this is a short term thing where things are going to be okay and you got to navigate it, it's not like they're just going to go back and say, oh my gosh, things are great, let's go invest, for tomorrow. And I think it's a much different picture for these oil and gas companies to sort of invest. And then that's where you start looking at, do we have a shortfall of investment for oil and gas, for the actual oil production that we need? And that's a whole separate thing. But just this oil equity space, I mean, you've painted I tend to agree with that, or that, I mean, they're in a kind of a tight window of the things that they have to do, and I think the pressures on them are pretty significant. But you also have, you Pickering Energy Partners, you guys are looking at a broad swath of stuff. You've put out this great title of your report, by the way, which I'm not sure I'm supposed to have. It was leaked to me. I'm just going to say you sent it to me. This inconvenient truths, is that what it's called?
Mm-hmm. That's right.
So, Inconvenient Truth Report, which I thought echoed a little bit of the, the Barclays, Volklov, Smeal thing that came out earlier this spring, just talking about the difficulties of how hard it's going to be to actually transition. And I think you point out in that Inconvenient Truths some of the stuff going on in the UK and just this energy crisis and some of these realities. So, with all that, given the hard things of the actual transition, given that the fact that, it's tricky for oil companies. They have a narrow window in which they're doing stuff within the equity market. But also that you said that, hey, interest rates might not be that high, so that bodes well for tech and green tech. That just seems like it's like everything a little bit too good to be true there. Like, how does that play out? Is that you can have all the green you want and ESG you want and all the oil and gas. It just seems like it's a little bit messier. And I think green tech and tech in general, but I think green tech has had its day in the sun this year, especially with with the tailwinds from the administration and the political endorsement. And then there's just a check on reality of how much this stuff costs and the fact that it doesn't give you as good of returns. And that does make me concerned when we have activist investors going to Exxon and going to Chevron and having them put 10% of their capex into this stuff that's not going to give them the same returns as oil and gas.
Wow. There was a
Sorry,
lot
that's a
there.
long rant. Yep.
There was a lot there. So let me say a couple
your
things.
favorite and run with it.
Yeah. Let me say a couple things around this. So I want to distinguish between the attractiveness of equities and the allocation of capital, because what I think is pretty clear. I think a couple things are clear from my perspective, but are muddied in the minds of investors. So when we think about energy transition, I think that investors would like to decarbonize. Sorry, there are a lot of constituents. Investors are one, institutional investors. I think governments, I think lots of individuals, and I think lots of corporations would like to see carbon out of the system really, really quick.
We're good.
So lots of people would like things to happen really fast. In Europe, they push really fast to get to renewables and lower carbon. And what we've seen in Europe is that going fast creates volatility and the risk of high price. It's expensive and it's volatile. And that's really probably not what anybody wants ultimately, but that's kind of the outcome of going fast to decarbonize. So I think that we're just at the beginning of people allocating real significant capital to decarbonization. So the money's coming. My personal view is that it will take much longer to affect the change that people want. And so in the meantime, what do? You use the stuff you've got. And so, you literally have people talking out of both sides of their mouth. Biden says, I want green everything. And oh, by the way, OPEC print more oil, produce more oil. And so there's the short term and the long term. And I think the wake up call this year, particularly this summer with all the stuff going on in the gas markets, is that the time period we're going to have to do both is going to be pretty long. And so we're going to need the bad guys for the foreseeable future. And so I think that the pace of the energy transition is overestimated, which means hydrocarbons are going to stick around and probably wind up being more highly priced than they otherwise would, because this overhang is big. Man, if you're a deep water oil producer, you've got a project that you're going to turn on in 2028 and it runs for 20 years. I mean, that's how much money do you want to spend on that project? So we've got an overhang that's creating this underinvestment in oil and gas. It's probably ultimately supporting a tighter supply-demand balance for hydrocarbons and therefore a tighter price. And then you look at, so I think that there's a ton of activity and a ton of dollars going to be spent on green tech, energy transition, ESG related stuff, whatever you want to call it. I call it decarbonization. It's going to be many new technologies and many existing technologies, and a bunch of it's going to get wasted. A bunch of it's going to get very low returns. I mean, I agree with you. BP buying windmills at a 5 cap is awful. Doesn't make me want to own BP stock, but it doesn't mean BP's buying those windmills. So there's low return for a bunch of the capital. And then there's going to be something, I don't know what it is yet. There are going to be some huge companies that come out of this process, because if we're going to take, if we're going to go to net zero in the next 50 years, not 30, that's going to be a massive industry. And so somebody's going to be the carbon capture guru, and somebody's going to have the widget that takes, carbon out of the smokestacks or whatever it is. So I don't know that I love a lot of the areas that capital is being deployed in decarbonization, but I think the money's going there. So I think that's a huge tailwind. And the sort of backside beneficiary of that are the oil and gas companies, because folks are poo-pooing them, but they're very necessary. And I think there has been underinvestment. I think the oil markets are tight. We're going to be tighter over the next 10 years than we otherwise would have been, because some money's not going to get spent because people are scared of what might happen. So again, I think that it gives me some comfort around one of the things I say right now is I'd much rather buy an oil well than a windmill. Mm-hmm. I think we're going to build more windmills. They're going to be a very popular investment, but at an unattractive return. Meanwhile, you've got this investment in oil wells that people aren't excited about making, where I think the returns are quite good. And so if you can get past the philosophical pieces of the argument around decarbonization, then I think you make a lot of money. And so I think you make more money.
You're painting and you say some amazing thing. I only want to interject because I want to ask.
Please.
You're painting a very clear picture that's very positive. Both, I mean, it's a little too good to be true. I mean, you're painting a very positive picture of like you can have it all. You can invest in. You're basically saying it's gonna look different than it does today in terms of decarbonizing, but that a lot of money is gonna go to decarbonizing. So there'll be, that's an investment opportunity, and that but it makes oil and gas look good from money standpoint, not from necessarily an equity standpoint, because they may still be hammered. But that right now there's so much uncertainty. What I think is fascinating is that there's this massive uncertainty in the oil space where people are scared and don't want to invest, but we know we need it. And I think I'm hearing more and more, and you alluded to this when you were talking with Chuck Yates in Clubhouse over the summer, when Chuck said that his son, was very anti-oil and gas, and he just was losing his sort of faith that, people were going to understand that we need this stuff. And you said, no, well, there was actually kind of a reverse already happening within people's portfolios, or some advising of switching over. And I had heard and seen, I'd heard him been saying really the same thing for the past probably month around then over the summer, when you started having, folks say they're and they would say it scaredly, but they would get on TV at 2 a.m. on Bloomberg, and they would say, hey, we don't love it, but we are starting to advise our clients, given this inflationary environment, to move a little more into oil. And they're like, oh, that's so bad. It's oil. But I mean, that's what they're doing. So it's a reality of that it was sort of already happening then. The having your cake and sort of eating it too, though, in that the money is going here. And I guess this is why we're both going to have jobs for a long time, is that, it's not, no one has the answer, right? There's no crystal ball of like, how do you invest in the green space and make money right now? And how do you invest in oil space exactly and make money? And I think they're going to continue to evolve. I think that if interest rates, though, go higher than expected, and we have some, even if it's a muted Volcker response, a lot of green stuff gets hurt real fast. I think that the politicians who are
hold on, let me interject. I agree.
Do.
I mean,
you're welcome to interrupt anytime.
Yeah, long term, and you can see it in the regular way tech sector, when interest rates start running, when you've got these massive multiples, higher rates hurt them, and green tech is no different. But what I want to say is, we're talking about, I think that the money is coming into the green sector almost regardless of the near-term return outlook. And so I think you may stop people making money on it, but you're probably not going to stop them trying to put more capital in there. So those windmills are going to get built at, whether it's a 4 cap or an 8 cap, guys want to build those windmills. So
Do you think that do you think, I mean, right now though, and there's a number of things I went to, but right now, wind and solar, those are the two biggest things, right? They're the easiest things. They're basically all the only real tech here. So when people get all excited about the fancy newfangled tech, it's basically wind and solar, which has been around for a very, very long time. It's not that new. And almost all of that is coming from China, almost all of it. So I don't see how it is as sustainable as people think it is. With this administration in place, turning a blind eye to the human rights abuses in China, I can see that it's sustainable, that we'll continue on that path. And I can see why China would continue to say, let's cooperate in the area. I can't see it with a different politically. If political environments change, I think it could be difficult for us to buy. The third largest wind manufacturer or turbine manufacturer for onshore is Xinjiang Goldwind in Xinjiang, and we know that 70% of the world's solar panels are coming from China. 45% of those are coming from the province of Xinjiang. So, and we know that labor is cheap because it's probably forced labor. So that's not a sustainable one. You're just assuming that we'll keep buying it from forced labor, or the world will, and maybe they will, which is not a good thing. And I'm very, very much against that. But I guess the only way it's really sustainable in the long term to me, beyond a political, and I do think politicians in Europe and in the U.S. have had a massive outsized role in how people view the energy transition right now and green tech. And I think it skewed people's vantage points of this significantly. But I just don't think that's sustainable. I don't think that you can have the serious human rights violations within China and continue to purchase these. So does that mean that those two things that are going to grow even without lots of money, and Siemens and the offshore stuff and BP, that's a whole separate thing, which I completely agree, paying a lot of money for that stuff. But in the US, and for the Western countries, maybe Europe keeps buying those from China, but are other people going to start making them? Are we going to start getting solar panels at a scale from places outside of China to really ramp that up? Because I don't see the only way China can keep the cost low, by the way, is to keep the labor, not paying that labor, because the costs are going up. And there is a reason why the costs have been low for wind and solar out of China, and it's because they aren't paying for the labor. So this is just a reality that I feel like nobody talks about, and it drives me batty when it's basically two simple things. It's wind and solar. That's how you're going to decarbonize the grid. You're okay buying it from China from forced labor. I'm not okay with that. But I do think I can't be the only one not okay with that. When push comes to shove, I just feel like if we're going to really put a bunch of windmills everywhere around the country, which I'm not sure everyone's going to want that either, I'm not sure anyone's going to want to build all those transmission lines either with a NIMBYism. But do those get purchased elsewhere, or is this hey, we'll just keep buying it and it's probably going to happen anyways because that's the momentum?
Yeah, the paper that you referenced, the Inconvenient Truths, and let me give credit where credit's due. That was written by our colleagues at the Sailing Stone Capital Group. They're a part of Pickering Energy, and they're super deep thinkers on this sort of stuff. I mean, Inconvenient Truths was all about the logistics bottlenecks that people are probably not as aware of as they should be, and whether it's where wind and solar equipment gets manufactured, or the minerals that we need to expand the electric vehicle fleet. All of these things, I think you're going to see a massive expansion of the whole supply chain, whether it's wind and solar, EVs, or batteries. And the stuff doesn't happen fast. It's going to happen globally. I think you will see a geographic dispersion of the industry over time, because everybody's going to be trying to ramp this stuff up if they're going to stick to these net zero goals, which I see no reason why people are going to back off of them in the near term meaning next 5 years at least. So, Trisha, I think you're going to see a much bigger sort of supply chain network for everything. But let me be clear. I think that it's going to cost more and take longer than people expect. And so by definition, that makes it less attractive. I mean, consensus thinks it's easier and cheaper and faster than it really is. And so the ultimate cost of decarbonization is much higher than people realize. And
it's already really, really high.
Well, but part of the argument, like hydrogen, for instance, is if you get it started and you start, government subsidizes at the beginning, you come down a cost curve, and all of a sudden this great low carbon energy source is available. Maybe that's true, but man, it's a lot of money and it takes time. And I just keep coming back to those issues. It takes money and time. And Europe showed us what happens if you go too fast. And so doesn't mean we won't try to go fast or other
Mm-hmm.
countries won't try to go fast. But ultimately, I think the big beneficiaries of the shale boom have been consumers.
Yes.
And I think that the whole decarbonization process, it's not clear to me that the winners of that process are going to be the consumer. We'll have less carbon. The government may have spent
Is
a bunch
it
of that
wait?
money, but
Is it clear that we'll have less carbon? Because I got to push back on that a little bit, and that's that we all talk about this. We're decarbonizing. Well, clearly, right now the big fast push that's happened in Europe has resulted in them burning oil in their power plants, and burning coal like crazy. So also when you go fast and crazy, you spend a lot of money, and some people make a lot of money. And I think that lots of people in the green tech space are making lots of money hand over fist. If you're putting a shovel into the ground, and I say shovel meaning a backhoe that's a Caterpillar, it's probably powered by diesel, and it's going to emit. So if you really do have an infrastructure boom and you are building transmission lines and you're digging dirt out of the ground, it's not plugged in with a Tesla. This stuff is going to actually increase emissions just to build it. And so I think even the fast, what makes me nervous in Europe is that we haven't heard a reckoning, a come to Jesus moment, a real and when Fatih Birol gets on TV and he's saying this is not about this energy crisis is not about green or clean tech. This is 100% fossil fuel driven. It scares the crap out of me that the people leading in Europe have aren't even willing to admit that wind, and not just wind, it wasn't wind's fault that this happened. It was that they didn't have enough natural gas backup, and that they also had hydro. Nobody's talking about the role of hydro here. That weather patterns did change, and you had a hot summer, and the hydro didn't go, you didn't have as much hydropower in Brazil, you didn't have as much hydropower in Europe, and you didn't have as much hydropower in China, and that all drew down on other sources of energy, including wind, which didn't blow as much, including solar, and gas, and all these base loads that nobody talks about of the base load. And so the speed in Europe, one, no one's saying, I've not heard anyone get on TV and out of Europe and say, this is really serious, maybe we should slow this down. And two, how much carbon are we emitting by running this so fast? So gets to me this question, and I had Chris Wright on the podcast, and when we asked the question point blank, is it about CO2 emissions? He would say 100% it's not. And I really think it's an important question to ask industry leaders. Do we understand, are we actually decreasing the carbon emissions? And if we're not, then what is the point? Because then it's just a bunch of money moving around and it's about politics. And I also get nervous in the U.S. I don't know so much for Europe because they definitely believe in it. In the U.S., when you raise prices like this and you raise it to the consumer, I'm going to bet you that politically, I think we already saw in early November and Tuesday. And the reason I bring up politics, it is heavily entwined in risk analysis for businesses. But I think with inflation and high energy prices, if the consumer doesn't feel good, I don't care how much they want to green and get green. They need to feel comfortable enough to vote those people in. And I think that in the U.S. we've sort of had a very rapid move on this progressive agenda, and I'm not sure it's being swallowed the way people thought it would. And so I'm nervous that I think in the U.S. for sure there could be a check on decarbonizing pretty quickly, given so much has been done via executive order. In Europe, I think it's a little bit different. But I really have to ask you the question: is all this being said, are we actually decarbonizing? And if we're not, then I mean that's especially for investors, it's a really important thing to think about.
Yeah. Well, I think so. The simple answer would be if building the new stuff has a surge in emissions, but you cut emissions over time, then the net impact is a positive. Are we really decarbonizing? I believe that the money that will be spent over the next 10 years will wind up lowering net carbon. How much? I don't know. I'm very skeptical of a 2050 net zero being able to accomplish that on a global scale, because we're already way behind. And I mean, the magnitude of changes are dramatic. So the answer is, I think these things will lower carbon. Does it lower it immediately? Probably not. But I mean, you got to get started on this stuff if that's your goal, right? What we're not, we could have a whole nother podcast on climate change and how real and human causes of temperature change and all that sort of stuff. Um,
which is really not, and I just want to say, I fully, it's not to be debated on this, in this episode of this podcast, and I fully respect people's vantage point there. But from a purely investment standpoint, and the risks, I think are quite big because, are we, if we aren't actually decarbonizing, and it doesn't, or if the weather doesn't change quickly, politicians have pushed a lot of this stuff and helped incentivize a lot of these investments, and have helped stimulate these investments and helped endorse them and given them the tailwinds, and also are subsidizing them. And if the political environment shifts because the economy erodes, and these dollar signs, if you look at the IEA report, holy crap, we're talking
yeah,
trillions and trillions for this stuff. So I just don't think the consumer is going to put up with it forever when, one, they don't see the weather change, and two, CO2 emissions keep rising. And so I truthfully am not nearly as optimistic. And I think, you may be very right. The people are going to keep putting money into it. I think there's a breaking point in which people keep putting money into it, because I don't think I think that it starts to break down. And that's not because you couldn't do this. If you had smart, intelligent people doing this with hydrocarbons in mind and saying, how could we actually transition? The problem is we're not actually transitioning. Like you said, when it's about speed, it's just they want it tomorrow. And that's politically driven, and it's not reality driven, and it breaks down and it falls apart, and it's killing their objectives. And that's where you start kind of bucketing who's in favor of the money, who's in favor of the emissions, who's actually in favor of the real thing. And the reality is, and oil and gas guys get, completely thrown under the bus, told that we're illegally, we're screwing consumers over because we are not causing oil prices to go up, which, actually the Secretary of Energy actually said that, that's OPEC. OPEC controls the gas market, according to her, which we were talking about oil, but that's a whole nother thing. So, you just have a lot of things all over the map. And the oil piece makes me nervous because, you mentioned that we're still going to need it and it's going to be tight. Nobody's acknowledged, at least in this interim period, of, can we work with the bad guys? We would have to have this to actually work. They would have to acknowledge that hydrocarbons are a piece of this. And, I've said on previous podcasts, I'm over saying fossil fuels because I just think it's demeaning and damaging to the industry. It's like calling tobacco. It is hydrocarbons. This is oil, natural gas, and coal. And, these things are, even if you look at IEA, the coal flatlines. Coal doesn't even tank off a cliff for demand, and I think it's going to be very, very difficult to tank, whether you want it to or not, to tank oil demand off the cliff. But the reality is, from an investment standpoint, it's going to be very, very difficult for oil and gas, because they have to navigate through all of these pressures, that you've explained really clearly. And I'm concerned that, is there any of that gives you hope that, one, you can sort of, there's an interest to work with the bad guys, that this can be navigated and there's a way to sort of move forward? Or, are my concerns that stuff can break down because just beating it up so fast could actually damage your thesis on the green side? And I know I threw a lot at you.
yeah, I think that, so the good news here for the oil and gas business is that we're going to need their product for a long period of time. And it's probably going to have an underlying bid that's better than it looked 5 years ago from a price perspective. So we've traded duration for price. We used to think we'll drive oil and gas, gasoline powered cars forever. We probably won't. So price is probably going to be higher as a result of that. But to your point about being the bad guys, I'm on record as saying I think that the industry needs to get used to being the bad guy, because I think that battle or war has been lost. And the view is going to be that, try going to college and recruiting somebody to come work for an oil company or an oil focused investment bank. It's hard, right? So a lot of folks just don't want to do it. So I think we wind up having this period of time where we're not particularly well loved as an industry. We make really good money, and we're always looking over our shoulder for the next regulatory bullet that somebody's going to fire at us. And I think that's just the reality. I think that
Then you are making a great case to just everyone go private. I mean, there's just really no point in being public, which I've
it's
thought for a long time. I mean, right now there's no point in being public. But see, to me, that's not. I mean, you accepting being the bad guys, and I get like, look, I've not been nearly as defensive about. I grew up in the oil and gas industry, and I, you need to call a spade, and when things are done wrong, they're done wrong. Colorado Firestone explosion, Anadarko, really big deal, was absolutely done wrong. Industry has done a poor job historically of getting ahead of problems, of being honest about those problems, of being and addressing them. But now's the time where the industry, I think, really you got to have some industry leaders that really actually go against. I think that I don't accept that. They have to get on their earnings call and say they're the bad guys because they're. I think we're getting to a point where they're almost lying to their shareholders when you have Mike Wirth, the CEO, at the beginning of this year, telling his shareholders, in his investor day, that he is going to be producing, that he is very bullish on oil and gas, and he believes that oil and gas the demand is there for a long time. And then he has a board meeting shakeout in May, and then he changes his tone a little bit and changes even his wording on the longevity of oil and gas. I mean, I'm a little concerned that's not quite, I guess it's not lying, but it's not, I mean, did he really change his mind? Does he believe that? I mean, that's internal investor pressure, and that doesn't seem really kosher to me. So I think you start getting into where it's getting really messy. And I mean, not every industry leader, I think, should accept that this is maybe from a making money investment standpoint and getting through it. You're right that you have to accept that you're just the bad guys. But I think that, man, from a tech standpoint, this industry has a lot left to give in terms of, has a lot. It's a pretty exciting business, has a lot to give. I mean, and a lot of people, and just nerding out on the rock standpoint. And I do think that we have more oil and gas in the globe, let alone in the U.S., than people realize. And the U.S. is probably, even now, part of what is driving oil prices down a little bit, not all of it, but a fraction of it is definitely people thinking that, the Permian is going back to 5 million barrels per day, that we're getting close to it already. We're going back to pre-COVID levels on the Permian, and just that people are pushing up on oil and gas. And, we're doing that all with way less rigs, way less everything. So there's just a reality that oil production tends, over my lifetime, over my career, 10 years, has been way more resilient than people realize. Oil production always tends to go to the upside, not the downside. And I think that lower oil prices are way better to the consumer. And I think if you want to be the good guys, you should favor a little lower oil prices. So personally, I think lower prices benefit the economy a lot, and these high prices aren't great for a lot of folks. But do we really have to accept that being the bad guys thesis to sort of just survive and live through it, or can that seems? I mean, I hate to be, that seems pretty crappy.
Well, I guess what I'm saying is that my personal belief is that we know that hydrocarbons make the world a better place from the energy density associated with hydrocarbons makes quality of living tons better. And the classic example for the person saying give hydrocarbons credit are the guy who's burning wood or burning dung, and he gets a natural gas power, either in his home or for cooking or whatever. Their life's better, no question. So I hear you, and that doesn't matter to Greta Thunberg. Greta Thunberg says we got to get hydrocarbons out of here, and so all I'm really trying to say is that notwithstanding all the positives, and notwithstanding that most people are still driving around using hydrocarbons, or heating their houses using hydrocarbons, or turning on electricity using hydrocarbons, the press is on. Maybe this is a better way to describe it. If we were in the sealing business, right? SEAL. What did those guys do? They went to the Arctic and they clubbed baby seals and brought their fur home. And that was awful. And people said, this must stop. And let's say that 90% of that went away. The people that are saying this must stop aren't going to go, fabulous. It's 90% better. They're going to say 10% of seals are still being clubbed. And I think that's where we're at now, which is I think the whole industry gets it. They're acting more responsibly. Emissions are coming down. They're focused on GHG. I talk to all kinds of executives all the time.
Mm-hmm.
These meetings, and they're spending money and really focused on doing better. And Greta Thunberg is still after their ass. Sorry to the kids who listen to your podcast. So that's what I mean when I say you're going to be the bad guy for a while. People are spending money. They're doing tons better. And I'm not sure they're going to get the credit they deserve for it. And you shouldn't, it's a cost to doing business now, and you shouldn't expect to be praised because
I agree with it. You're gonna expect to be praised. I don't, I respect Greta for what, her values and beliefs, and that she goes out and does it. But she doesn't have a PhD, and she's not an economist, and she's not an expert or scientist. She's actually, she doesn't have anything other than she says blah, blah, blah a lot now, which is, there's not much there. So it's a lot of blah, blah, blah. ESG though. So that being all said, you're basically saying these operators are going to have to navigate this. I do think there's a convincing argument to stay private, or actually to go private, given all this. And I don't think the Greta, she's made it onto Marvel shows, at least her voice and stuff has been onto. So you have that, but you also have the media 100 in the pocket of a very biased sort of media that's leaning in to the scare tactics of every weather event being catastrophic and being caused by the oil and gas industry and all these things. And I think that's a reality from an investment standpoint of analyzing risk. It's like, okay, well, where's the media? Where's the political? And I do think the politics side matters a lot. That in the U.S., if this midterms don't go the way Democrats want them to go, and if that switches, and then in 3 years, if the White House is not a Democratic White House, I'm not sure this looks the same in the U.S. I mean, we didn't have we didn't even talk about inflation and progressive and we didn't talk about inflation the way we talked about it last year at this time. We didn't talk about entitlement packages. We didn't talk about the social welfare spending, and we certainly didn't talk about the green stuff. This all changed within a year. So if it can change that quickly, I think it can change back. And the U.S. has that was all that was talked about, was that we weren't part of the Paris Climate Accords, and now we're part of the Paris Climate Accords. And this is just, and by the way, that didn't even go that well at COP26. It was pretty watered down by India and China actually toward the end. And I mean, it's a hard reality that I think if I was, I'm not advising people on individual stocks to invest in, but I mean, I was listening to a podcast with Oxford Institute of Energy Studies on India. And, there's a lot of optimism by some folks in the natural gas community on India, some of them that's not. They lack the infrastructure. It's a very messy system. They still have a lot of coal. And then they're trying to go to renewables. Really, really messy. But they need it, right? And to your point of like the people in their houses, like they're trying to get people to stop using wood, so they're bringing in an LPG, and so there's a potential growth there for just that standpoint. And so you have these places within Asia where that actually to decarbonize, they're going to have they may want to be renewables tomorrow, or actually I think the developed world wants them to want to be renewables tomorrow. But the reality is, to actually do it, they're going to need natural gas, not just because for decarbonizing, but literally just to elevate their economies. And in it's going to actually decarbonize. And so that's going to happen. The tricky part is how does that actually work out in the wash with, companies like Cheniere and Tellurian and, in the US and actually getting things permitted, and how much we export is it all comes back to how people actually spend money in doing business. And I think there's a good thesis to be said, like you said, that hydrocarbons are going to be in the pool for a long time. The ability to invest in them is going to be hard, and you're going to have to find unique pathways, and different. And I think the political environments are going to have to be navigated because they bias investors, especially now when you have the secretary that, Janet Yellen, who is a political appointee and talking about climate change. And even there was a post on Jerome Powell, how many times he said climate change. The fact that you have these bodies that are talking about climate change that impact how people invest their money, that's important. And that means that the role of ESG, and this is kind of whatever you scribbled on, I'd love for you to, follow up and make sure you interrupt me on. But the last thing I guess I'd like to close with, because I'm still struggling with, how real is ESG? I know it's real and I know people invest in it, but the impact it's having, when we talk about just investor pressure, I think that investor pressure changes. I think it's fluid. And I think a lot of folks are viewing the right now of ESG and the momentum it has and the investor pressure on hydrocarbons, on oil and gas equities. I mean, you name it, on every company. And it's on insurance companies now that insure coal mines and everything. All of this is weighing, but I think it could be a little transitory in nature. And I would like to know how you think about that, and maybe you personally, but also Pickering Energy Partners, of that we tend to view, like, did we view that when people were talking about downspacing with wells and the analysts freaked out in New York and they were like, oh my gosh, the Permian's over and the U.S. oil boom is over because we put the wells too close together and it's over. And oh, by the way, it wasn't over, and they widened it up a smidgen and got the monkey off their back, and it's fine, and production is going back up. That same thing, 2015, 2016, you had to buy in the Permian. You had to, no matter what, you had to get out of the DJ. You had to buy into the Permian. You had to get into the Permian, anything. You have now Continental Resources in the Permian Basin. I mean, but at that time, it didn't matter that you were making money. It was just get into the Permian. And then immediately it was be free cash flow positive. And now it's be free cash flow positive. Now it's give every penny you make back to shareholders. Now it's variable dividends and real dividends and stock buybacks. And I'm not sure that's a great one, but and it's but don't hedge. And I mean, all these things change. And before it was, well, I mean, if prices go down $20, it's going to be like, well, how come you weren't hedged? Well, you didn't tell me to hedge. I mean, so this listening to these investors and this pressure, I think it's really scary a little bit in terms of how much eventually you have to, whether you're an oil and gas company or just any company, you still have to run your company. I mean, your investors, yes, they matter. You got to give returns, but they can't dictate every move. You run a business and you've got to run it. And I think in the oil and gas space, I'm not sure if they got a little lost, but I'd love to know if you can just give me, nobody has given me an articulation of how they feel about this transitory nature of investor pressure. And I think it's important to talk to folks about it, because it's just, there's no way it can be exactly like it is today forever. I mean, it's just going to continue to evolve, right? Or maybe not, right?
No. Energy's a cyclical business. And so if we think about the kinds of investors that owned energy last year, they were bottom dwelling, value focused, NAV. This business isn't going away. I don't mind to own it for 5 years until it gets better kind of investors. Those people, those shareholders want different things than growth-oriented shareholders that tend to own the sector when commodity prices are higher. Commodity prices are typically higher, sending a price signal to grow, production, which means you're talking growth companies. And growth investors want 25% production growth, and they reward you for taking action that can get you on that path, a la get in the Permian at any cost. So because we're a cyclical business, by definition, sort of the investor base does change. And now we have the added wrinkle of ESG, which is changing the playing field a bit. There's a reasonable amount of money, a lot of incremental money that's come in around these characteristics. And so it's changed the bar for the whole market. It's a tougher bar to hurdle as an energy company because the E piece is more challenging. I think that what we've seen is that
so is the S and the G. We just keep focusing on the E.
Well, there's the G piece. The governance of an oil and gas company shouldn't be any more difficult than governance of a manufacturing company or a tech company or whatever. The social piece of it, in theory, a good social operator or a good governance, that should be ubiquitous across all sectors. The E piece is a little harder because everybody does things, they have different businesses that impact the environment piece of it differently. So I think the bar is higher than it was 2 years ago. I think it'll be probably even higher over the next two. I think there's some momentum to the ESG dynamic that hasn't completely played out yet. What's the result? The result is if you are a public company, I mean, boards are under scrutiny around this. And so what do? They ask the companies, what are you doing on this? There's a lot of money being spent on ESG. You know, whether or not the pressures will be as dramatic in 2 or 3 years, this is making companies better, in my opinion, right? Not necessarily more profitable, but it's making them better. So emissions are down, and um, and the stuff that we care about from an E perspective is getting more attention. Are they the right things? I mean, one thing that I'll call attention to is that these rating agencies that rate ESG, um, they're they're very mechanical and algorithm driven. They're they're unwilling to standardize because that takes away their proprietary stuff. And so you've wound up with a very disparate set of ESG criteria, and we haven't standardized very well in the US, but I think it's coming. I also think, Trisha, that ESG disclosure is requirements are coming. And so uh, I think that the game is getting tougher. Table stakes are getting tougher. Now, it also says that it's another reason why being a private company, so you can do whatever the hell you want within reason and not be pushed around by investors or banks or whatever. So I think there will be more companies that decide to stay private versus going public because the
But
cost of being a
you
public
really
company is
think
higher.
I can't help but ask this because
Please.
I don't believe that I think the E has been elevated way more than the S and the G. I think actually the S and the G have fallen completely by the wayside because
I'm sorry. I apologize. No, I mean there's 10 times more focus on E than S and G. That's for sure.
well, and that's the problem is that I don't know if you can I'm just not sure you can have when you elevate the E. So when you elevate the environmental issues, you can actually exacerbate the social and governance issues, and it's like a whack-a-mole thing a little bit. But and this is where I think the China thing comes back. And this is there is a very good episode from the South China Morning Post on China geopolitics that I think it came out in like December. I was driving or not December, sorry, it was over the summer. I was driving home to Craig, Colorado, and I was listening to it. And this guy and had nothing to do. They had nothing to do with the stuff that I had connected it to with, but it was which was the Exxon stuff that I was interested in because I had just heard those names. But it was BlackRock, State Street, and Vanguard. And this guy in the podcast was just pulling up that they had all had. And by the way, BlackRock, you can Google them, and we all know the names, but you can Google them, and they have a nice ESG talk. They have actually a nice social thing. They've got a whole slide on human capital on their social and governance stuff. They're all complicit in like human rights issues within the province of Xinjiang. They have like board members. They've actually a part of the decision makings in some of these bodies. So they're in the interworkings of this stuff. So I would say that I call BS on the S and the G part there. And those were the three names that apparently were the big push and driver in getting, Exxon to, get those board members from engine number one. And that to me is where I do think it's green. It's just there's too much BS going on that it's what is it really about? And that to me is I don't think it's any benefit to the company. And it makes me nervous that people are so buying it. Beyond nervous, people are buying into this. I mean, this engine number one raised a green fund on the back of all that publicity from that. That's
Mm-hmm.
just about money. So if you're anti-corporate America, anti-money, I mean, talking Greta Thunberg doesn't believe in the economic growth. That's what this is, people. People are making a crap ton of money on this stuff. So it's no different to me than oil and gas, but you got to call it what it is. I mean, this is just a green fund. That was a publicity stunt. And what did it actually accomplish? And by the way, I mean, they're going to lose money. 10% of CapEx going on for Exxon going to all this stuff is not going to help them make money. It's probably going to help them lose money. But it just means that I think you got to be careful because I think that E gets elevated, the S and the G doesn't. And then, yes, you're right. You're probably right. I mean, on paper, they've lowered emissions, but we do know that in the U.S., if we take all of U.S. oil and gas production, all of their emissions in the U.S., it is 1% of CO2 emissions. So we could get every single company to get their emissions zero. Now, methane is a different story, and I agree that's a different ball of wax, and is not addressed the same. But if we took it down to zero, it would be 1%. And so I just think if it's really about emissions, we got to start focusing on what we're actually trying to tackle. And I think that oil and gas companies are highly penalized for they're trying really hard to solve for their emissions, which is a drop in the bucket to the actual emissions, and they're hated anyway. So really it's like, okay, go after, they're hated anyway. And I that's my concern, is they're going to go chase this ESG stuff all they want, and they're going to chase and chase and chase, and they're going to do what the investors tell them, and the share price isn't going to move, and it's not going to move the needle for them. The question is, do they get into some nice long only basket, and do they do enough that they stay there? And I know this is all reality, and I don't see, I tend to push back on folks that in your community that know it better than I do, but it just doesn't seem like it's like that they're working really, really hard to move the needle on something. And it doesn't mean you shouldn't work on ESG, and you shouldn't have, work on a diverse board member and stuff like that. It just means, are you really moving the needle?
Are you really moving the needle is one question, and then the other question is, if you're not moving the needle, or if you're not taking these steps, are you going backwards? And I think that the risk to the energy sector, and I apologize, just to clarify, what I meant was, I think that relative to the other industries, the E piece of ESG gets a lot more attention in oil and gas than it does, in other areas. But I think the real challenge is, if you don't make some of these changes, one, your peers and competitors are, and two, there's an expectation that you do make the change. And so if you don't, you may wind up, it's not where you get included, it's where you get excluded. If you wind up on a list that somebody's not going to invest, over time, you are disadvantaged versus your peer group.
Yep. So it's about getting in those buckets and those lists, but then somebody's creating those too, right? So it's got to be someone's creating those lists, and I'm not sure that's a level playing field if we don't have this all mapped out.
The list makers and the raters are not great, and there's some gamesmanship there for sure. And so it's I think over the next 5 years, there will be a lot more clarity on what the requirements are and should be. And then there will be less gamesmanship and more reality to all of it. But in the meantime, there's a fair number of bouncing around in the dark, which I agree isn't necessarily a money-making proposition.
And that means we just could be, especially with the stuff I was saying too about the short-term political environment nature, and seems that in the next few years it could be a little bit in flux in the U.S. Could be. All right. Well, with that, Dan, I have I'm sure we could easily keep talking, and
we could go for another 2 hours.
Well, and they're really good. These are topics that keep going. So one, I will absolutely have you back on the podcast, and we will continue this discussion, especially talking more econ and different things. So I thank you a ton for joining me. It's been an hour and 17 minutes of nerding out on all these things. So appreciate your time. Really appreciate the disagreements, and you willing to hear me out and push back a little bit. So that's great. I think it's awesome for the listeners, and just want to thank you again. Trisha, thanks for having me on. I look forward to coming back. Awesome. Okay. Bye. Bye.